Mortgage rates just took another step higher this week, climbing to 6.68%. Stronger than expected economic data has been driving the bond market, and that means mortgage rates are back near their highest levels seen in months. So, what does this mean for home buyers and refinancers? Should you lock in now or wait for a possible drop? Let's break down what happened this week and what to expect next. This week's rate movements have been driven by a series of stronger than expected economic reports. After rates had moderated slightly earlier this week, they moved up again by 0.5% on Thursday, hitting 6.68% by Friday. That's up from 6.64% just last week. So, why did this happen? Let's dive into the numbers and what that means for mortgage rates going forward. Let's take a look at this chart showing the 10-year US Treasury yield movements this week. The bond market was closed on Monday, October the 14th for Columbus Day, so we didn't see much action until Tuesday on October 15th. The 10-year Treasury yield finally took a breather after rising for 8 straight days. By Wednesday, the yield was looking better with a slight dip that gives us hope that rates might stabilize. But then, on Thursday, October the 17th, was a big day for the bond market, and it all started with the release of stronger than expected economic data. Let's walk through the numbers and explain why they had such a dramatic impact on mortgage rates. First up was retail sales, which rose by 0.4%, beating the forecast of 0.3%. While 0.1% difference might not seem huge, it does suggest that consumers are still spending at a healthy rate, which signals strength in the economy. Stronger retail sales suggest a resilient economy, which can fuel inflation concerns. Inflation is bad news for bonds because it erodes the value over time, leading investors to demand higher yields. And as we know, higher bond yields typically push mortgage rates up. Then came the Jobless Claims report that showed 241,000 new claims, much lower than 260,000 that were expected. Lower jobless claims indicate that fewer people are losing their jobs, which is another sign of a strong labor market. A stronger labor market means more people are employed, boosting consumer spending and potentially keeping inflation higher. This puts pressure on bonds and leads to higher yields and ultimately higher mortgage rates. Then came the Philly Fed Business Outlook, measuring business conditions in manufacturing sector, which came in at 10.3 compared to a forecast of 3.0. This was one of the biggest surprises of the day. A strong manufacturing outlook suggests that businesses are growing and expanding, which is good for the economy but bad for bonds. It means inflationary pressure could stick around longer, pushing bond prices down and yields up, further raising mortgage rates. And then came the industrial production, which fell by 0.3%, a bit worse than forecast of minus 0.2%. While this indicates a bit of a slowdown, the decline wasn't enough to offset a stronger retail and jobless data from earlier in the day. Business confidence also ticked up slightly, coming in at 43 compared to a forecast of 42 and last month's reading of 41. This indicates that builders are still feeling relatively optimistic even as rates rise. So, what does all this mean for the bond market and mortgage rates? Essentially, stronger than expected data, especially in retail sales and jobless claims, fuel concerns that the economy is still too strong for inflation to cool off. And when inflation is a concern, bond investors demand higher yields to compete for the risk of eroded returns, and bond yields rise. As bond yields rise, mortgage rates follow, which is why we saw the 10-year Treasury spike to 4.121% by the end of the day on Thursday. While it pulled back slightly on Friday, the yield still ended the week at 4.082%. So what does all this mean if you're buying or refinancing a home? Right now, a 30-year fixed rate mortgage sits at 6.68%, and for home buyers, this means monthly payments will be higher, and for refinancers, locking in a rate now could feel like a race against time. Mortgage demand is cooling off as rates continue to rise. Last week's mortgage applications sank by 17%, marking the sharpest weekly drop in mortgage demand since 2015, outside the pandemic period. Refinance applications dropped by a staggering 26%, while purchase applications fell by 7%. These numbers reflect how rising rates are keeping both buyers and homeowners on the sidelines as higher borrowing costs make monthly payments more expensive. Looking ahead to the next week, there are several important reports to watch which could impact mortgage rates further. On Monday, we have the US leading economic indicators report coming out at 10 a.m. This will give us a broader view of economic activity. A weak reading could help take some pressure off mortgage rates. On Wednesday, we'll see the existing home sales report for September, which will provide the insight into how the housing market is performing amid these higher rates. On Thursday, jobless claims data will come out again, and if jobless claims are higher than expected, it could signal a weakening labor market, which might finally ease bond yields and in turn mortgage rates. We will also get S&P Flash US manufacturing PMI and new home sales numbers, both of which are important for understanding broader economic trends. In general, we'll need to see some weaker than expected data for mortgage rates to come down. If economic reports continue to show strength, we could see mortgage rates stay elevated or even rise further. So, should you lock in your rate now or wait for a potential drop? If you're concerned that rates might rise even further, locking in now could be a safe choice. But if you think the economy could slow down, there may be opportunities to get a slightly lower rate in the coming weeks. As always, I'll be here to break down the latest data and give you the insights you need to make the best decision for your mortgage. Make sure to hit that subscribe button and turn on notifications so you don't miss out on any updates. And let me know in the comments, do you think rates will keep rising or could we see a drop soon? I'd love to hear your thoughts. Thank you for watching.